You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 13th of December 2025, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Sage, Imperial Brands, Big Yellow Group, British Land Co., PayPoint, and our US company of the week is Nvidia. John, should I start us off with Sage?
Yes. How is this British technology group doing?
I think they're doing pretty well. So for anyone who's not familiar with Sage, they are the accounting services provider. They have come out with their full year results to 30 September 2025, and revenue was up 8% to 2.5 billion. Operating profit was up 17% to 530 million. So that means the operating profit margin has gone up from 19.4% to 21.1%. Basic earnings per share was up 18% to 37.7p a share, and the dividend was up 7% to 21.85p a share. In terms of their underlying financial metrics, they've said the annualized recurring revenue was up 11% to 2.57 billion, and that was up 10% organically. Underlying total revenue was up 10%. Underlying operating profit was up 17%, and the underlying operating profit margin was up 1.5 percentage points to 23.9%. Underlying EBITDA was up 15%, and the underlying EBITDA margin was up 1.2 percentage points to 27.6%. Underlying basic earnings per share was up 18%, and the underlying cash conversion was down 13% to 110%. The CEO, Steve Hare, he said in his comments, AI is opening up new possibilities for businesses and creating a significant opportunity for Sage, enabling us to enhance and accelerate the benefits our software provides. Sage Copilot is already creating value, helping customers making smart decisions and be more productive, while our launch of AI agents is delivering the next wave of intelligent solutions. With our global platform, trusted brand, and focused innovation strategy, Sage is exceptionally well positioned to support small and mid-sized businesses as they adopt AI-enabled services. This drives confidence in our ability to deliver strong, sustainable growth and long-term value for all stakeholders. I would be very, very skeptical about the AI coming out from Sage. I don't think it's really big enough to invest the money it would need to have like a true AI. I think it's covered it before, but I think it's just a bit of a buzzword with a lot of companies. And I'm sure they are making the software better, more helpful, a bit more, intuitive in the way you can talk to it. But I don't think it's going to be a true, like if I'm looking for an AI play, I'm not sure I'd be picking this over, say, Nvidia, which we'll be covering later. I might for other reasons, but not for AI. In terms of the financial highlights, as mentioned, statutory operating profit was up by 17%, and they've said that reflects growth in underlying operating profit together with lower acquisition-related expenses. They've said the strong cash performance with underlying cash conversion of 110% reflects continued growth in subscription revenue and good working capital management. They've highlighted the robust balance sheet with 1 billion of cash and available liquidity, and the net debt to underlying EBITDA is 1.7x, which seems fine. They have separately announced a £300 million share buyback programme. That is on a market cap of about 10 billion, so it's 3%. So it's pretty decent. In terms of the operational highlights, there was growth across all regions, and that was balanced between new and existing customers. The renewal rate by value was 101%, reflecting strong retention rates and a good level of sales to existing customers. Sage Business Cloud increased by 13% to 2.08 billion. Increasing cloud native revenue growth of 23% to 885 million. Subscription penetration increased to 83%, driven by growth in subscription revenue of 12%. And for the 2026 financial year, they said they expect total organic revenue growth to be 9% or above. Operating margins are expected to continue trending upwards as they focus on efficiently scaling the group. Interestingly, because we don't cover Sage, I don't think that often, but so if you look at the last 5 years of financial information, it's grown revenue from 1.85 billion to 2.51 billion. It seems to be hovering around kind of upper single digits, low double digits each year. Gross profit That's gone up from 1.72 to 2.33 billion. So again, similar levels. The operating margin, that's actually been pretty flat over those 5 years. So it doesn't seem to be a business that's kind of scaling hugely well. Net profit, that's grown quite well as well over the period, although that's been a lot more lumpy. But cash flow is probably, again, similar, albeit lumpier. But yeah, it's a good business. In terms of the valuation, it trades at a PE of 25 and has a yield of just over 2%. So yeah, I think it's obviously a very good business. I think in terms of the performance, a lot of these figures remind me of kind of what we've been used to seeing from like Rightmove and Auto Trader. The issue I've got with Sage is it's not really a monopoly. You've got Xero, you've got QuickBooks, there's loads of other smaller software providers. I mean, where I work presently, I'm kind of less involved. I have less interaction with the people that are actually pushing these products out to clients. I think a lot of clients actually as well, they've kind of already been set up on one software provider, whether it's Sage or Xero, and moving's quite a hassle. So you'd have to be really unhappy with it to actually move. But the impression I always got was that Xero was probably the best operator. And then Sage kind of sat in between Xero and QuickBooks. From what I've seen anecdotally, and this is just based on like a couple of small accounting firms, but from what I've seen anecdotally, I don't feel like there's any kind of competitive advantage with Sage. I'd question how long they're going to be able to keep increasing revenue by that rate. I mean, you look at the retention, that's 101%, but I think they're increasing prices by like kind of 8, 9, 10% a year. So there is a drop off, but they're making up for it with the extra prices. But yeah, I just think you're paying a Rightmove valuation or an Auto Trader valuation, but you're not getting the monopoly. And although it's a good business, I think for me, I'd want to see it quite a bit cheaper before I actually took a look at it. What about you, John?
Yeah, I think that would be my main concern. And I appreciate the retention rate is very high, it's a sticky product. However, my concern would be, I guess, for those new businesses that are starting up, if, for example, Xero is a superior bit of software and a better operator, then is the market share going to sort of essentially continue to dip over the years? And that would be my main concern, I think, with Sage. And as you say, if you're comparing it with an Auto Trader or a Rightmove, they're pretty monopolistic and it's a similar valuation. So I think that would be my main concern. But the numbers that they're putting up, very good. And it does seem overall like a fairly high quality operator. But I think that would undermine the investment case for me.
Right. Shall we move on to Imperial Brands then?
Yes. So, second largest tobacco company listed in the UK, and I think it's fifth largest worldwide. So, they had their full year results out last week, or in fact, now I think it was a couple of weeks ago. Sorry, we're a little bit behind on the show, but they had underlying revenue growth of 4.1% to £8.3 billion. Moderating tobacco volumes declined 1.7%, were more than offset by strong pricing, and the sales of next generation products were up 13.7%. Underlying operating profit increased 4.6% to £4 billion, in line with previous guidance, and free cash flow of £2.7 billion was up 12.9%, helped by a one-off tax repayment. And this financial year, Imperial's expected free cash flow is to be at least £2.2 billion, supported by low single-digit tobacco and double-digit next-generation net revenue growth, and between 3 to 5% increase in underlying operating profit. The full-year dividend was raised by 4.5% to 160.32 pence per share. And as previously guided, buybacks this year are set to increase from £1.25 billion to £1.45 billion. And the shares were up nearly 3% in early trading. In terms of valuation, Imperial Brands had a market cap of £25 billion and trades at 9.1 times forward earnings, compared with a 10-year average of 8.6, and it has a prospective dividend yield of 5.4%, again compared with a 10-year average of 7.8%. I thought these were decent results. It was certainly compared with when we were covering Imperial Brands a couple of years ago, and you were seeing volumes fall fairly significantly. I think it was both the case for Imperial and British American that they were in the higher or mid to high single digits, which now has moderated quite substantially. they're obviously managing to increase the prices to offset even the smaller decline in volumes that they're still having. And the next generation products are growing at decent rates, perhaps not the rates that they were a few years ago, but still at decent rates. It's interesting as well with Imperial Brands because they've got a new chief executive in place. I think the last chap, his approach was more kind of back to basics with Imperial after they tried a real kind of growth strategy in the early 2010s. They spent a lot of money buying Blue, which was one of the e-cigarette brands, for I think 7.1 billion back in 2014. And then his approach seemed to be more just returning cash to shareholders. And I think looking back before the podcast, returned 67% of its market cap when he launched the strategy in 2021 to shareholders through dividends and share buybacks. And that was about a capital return of 10 billion between January 21 and the end of 2024. I think that seems to be the direction that they're continuing to go in. And it's certainly not an expensive valuation. I think everyone will have their own ethical opinion about Imperial Brands. But certainly now, when you look at it, it's not that huge dividend player that it used to be. I mean, it's still fairly significant. And they also have, a decent share buyback going on there too. But it's perhaps not what we've seen it as since starting the show. I can remember when it was down in the was it even in the high teens when we were covering it, Sam, in terms of per share?
I think it might have been.
And now
we're
over 30.
Certainly that was because it was a bit higher for Imperial.
Yeah,
Than it was for British American. It's definitely around the same. I think it might somewhere between 9 and 11% is where I'd put it.
So in terms of overall, it looks like very decent set of results for the company. I think one of the things that you do see with both British American and Imperial is that with ESG investing, it's not being picked up by a lot of the big funds. So I think arguably that probably depresses the value further. And obviously that's on ethical grounds. So I don't think the shares are particularly popular. But if you did look at it purely on the numbers, it has returned an awful lot to shareholders in the last 2 years, which is, certainly interesting. And they're not chasing that huge sort of growth strategy. And it does show, I suppose, the principle that, whether it's oil or gas, whether it's tobacco, that purely on a monetary side of it, they can return even if it's an industry in structural decline. Sam, what are your thoughts?
I pretty much agree. I just think as an investment, I can see why it's attractive. Obviously, we've talked about it for years, why it's attractive as an investment, ethical concerns aside. However, also in the time we've covered it, this is probably, the most expensive we've seen it. Or probably, I don't know if we were doing the show back then, but like kind of 2019, it did quite well then, didn't it? And just after Brexit and I think the elections around 2019, it did pretty well. But I think depending on how the wider economy is doing and whether people want to sort of gravitate more towards kind of defensive stocks again, it seems to sort of rise and fall. I think if you are interested in it, I would kind of question why you hadn't already bought it when you had the chance to get a 10% dividend yield. But if you are still wanting to take a look at it, I'd seriously consider just waiting a couple of years because I think that valuation will get pushed down. I know you can argue, well, at 9 times forward PE, 5.4% yield, it's still pretty cheap. But I just think, well, when you can get 4% in the bank, I think if you wait, you'll probably get the chance to get it at more attractive valuation.
Well, I think that's the other thing just on that point that you make is that if you looked back pre-COVID, well, I guess it was more around 2022, but in that kind of 2008 to 2020, 2022, when you had ultra low interest rates, then the dividend of, if you were getting, for example, what was it now, 5.4%, that would be very attractive. Whereas, as you say, it's a lot less attractive now when you can get that in a bank, or you can buy a sort of low to no risk gilt, for example. So I do hear what you're saying there. Bond proxies being just generally less popular.
Should we move on to Big Yellow Group then, a company we've not covered for a
Yeah.
while?
How are they doing? Because we've covered some other sort of REITs and storage companies.
Yeah, so I think it's been a few years since we did Big Yellow Group. We tended to do SafeStore more, which is the biggest in the industry. Big Yellow Group, it does a self-storage. They are pretty much offering a homogenous product. So yeah, it's just the big warehouses where you can go and store your stuff. You will recognize the Big Yellow Group ones more easily because they are big and they are yellow, hence the name. So Big Yellow Group, they have come out with their half-year results for the period ended 30 September 2025, and revenue was up 2% to 105 million. Store EBITDA was up 5%, 74.3 million. Adjusted profits before tax was up 9%. Earnings per share was up 7% to 30p a share. The interim dividend was up 5% to 23.8p a share. Profit before tax was down 49%. And the cash flow from operating activities was up 6%. Basic earnings per share, that was down 49%. And the EPRA, earnings per share, was up 7% as mentioned, so I think they must be adjusted. In terms of the store maximum lettable area, that was at 1%. Closing occupancy, that was down 2.7%. And as a percentage, that now sits at 77.5%. And for like basis, in terms of the stores they had at the start of the period compared to the end, it was at 78.2%. And the average rent per square foot was up 4%. They've said the difference in the profit before tax, so the profit before tax, as mentioned, was down 49%. They've said that's just due to revaluation gains in the prior period that were included in that figure. Cash flow from operating activities increased by 6% to 56.9 million. They opened a new 70,000 square foot store in Staines, London in July, and a 72,000 store in Queensbury, London in October. They've acquired a property in Coventry. They've exchanged contracts on a property in Bethnal Green. And that takes the pipeline at 30 September to 13 development sites and one replacement store of approximately 1 million square feet, of which 10 are in London or within close proximity. And they've had planning consent granted for the proposed store in Leamington Spa, and 9 of the 13 pipeline stores now have planning. They have also been in the news because they were in takeover talks with Blackstone. I can't remember which one, but Blackstone had been heavily involved in one of the other REITs we covered, wasn't it? I think it was Tritax. I think
it was.
They were going to buy Warehouse, and then Blackstone beat them to it, and then they bought a load of assets off Blackstone, I think is what happened.
Yeah.
So Blackstone have been quite busy. So they were in takeover talks with Big Yellow Group. However, I think it was last week, they announced that the talks had ended. They'd announced in October they were considering a potential takeover offer, and then under takeover rules, they had until 8th of December to make a firm offer or walk away. Big Yellow Group said, subsequently, Blackstone has provided to the board of Big Yellow today an update on the status of their evaluation of a possible offer and the valuation level at which it could make a proposal. The board considered that this in the context of Big Yellow's strong performance, strategy and business model. It has concluded there is no basis for continuing discussions with Blackstone. Big Yellow said the put up or shut up deadline will not be extended. So that's the end of that. It's difficult with Big Yellow, actually. I always find it quite difficult to value because obviously in terms of PE, which we'll get to now, it seems fairly expensive, but then you've got a lot of value on the balance sheet. So in terms of valuation, the PE is 17.28 and the yield is 4.61%, but you've got a very, very solid balance sheet. I think these results were okay. I think the 2% growth is not amazing, but I think the self-storage market is now pretty saturated. I think the issue, it's not a terrible company. I wouldn't say there's a huge difference between Big Yellow and SafeStore. I know SafeStore's bigger, but I wouldn't say there's really brand loyalty or anything. So I don't, other than some minor kind of gains from being the biggest in terms of like efficiencies and stuff and economies of scale, I can't imagine there isn't a huge difference between the two, I think, when we cover them. I think at a 4.6% yield, you could probably do a bit better, but then that balance sheet is really, really secure. And you probably get some capital growth as well as the value of the properties increase. So yeah, I think you could do a lot worse, but I just think the issue for me would always be opportunity costs. I think there's so many companies I'd want to own before I got to Big Yellow or even SafeStore. What do you think, John?
Yeah, I would largely echo that. And I think in the REIT space, there are lots of other very attractive options. You mentioned Tritax before. I'd probably say I would choose that over. I think that's got probably more growth behind it and the sort of REIT that or the sort of area of REITs it's operating in. The two that I own are Supermarket Income REIT. I think that's got a very healthy yield and it's very defensive as well in terms of supermarkets being really stable area of the market. In terms of other ones and potentially more in the growth industry, there is the healthcare REIT, which is Primary Health Properties, and that's recently acquired Assura Group. That is huge. I think there's a lot of emphasis to deliver more healthcare in the community as opposed to in hospitals. And that's also got a dividend of about 8% at the moment. So for me, I prefer those. I think there are lots of attractive valuations out there, though. I think they're possibly more attractive in terms of the valuations as well. So I don't dislike Big Yellow, but I think there are better options there.
Shall we move on in that case?
Yes, absolutely. So
To another REIT, actually.
Yeah, that's what I
I
was
don't
going
think
to
Big Yellow
say.
is actually a REIT, I don't think.
No, okay.
But it may as well be.
Yeah, REIT light. So, yes, this is a proper REIT. It's British Land. It had its half-year results out a couple of weeks ago, and half-year net rental income rose by 9.2% to £238 million, which was driven by like-for-like net rental growth of 4% and acquisitions. Underlying profits rose by 8.4% to £155 million, helped by revenue growth and lower admin costs, partly offset by higher finance costs due to higher development investments. Estimated rental value, ERV, property income under ideal conditions, that rose by 2.4%. Total occupancy across the portfolio was 95%. Portfolio value grew by 1.2% to £9.8 billion over the half, and the portfolio's loan to value ratio rose from 38.1% to 39.1%, reflecting higher development investment. For the full year, like-for-like net rental growth, that's now expected to be around 5%, with underlying earnings per share of at least 28.5 or 28.5% against a consensus of 28.7p. An interim dividend of 12.32 pence per share was announced, which is up 1%, and the shares were down around 1% in early trading. In terms of valuation, British Land has a market cap of £3.82 billion and trades at 0.59 price to book, compared with a 10-year average of 0.69, with a prospective dividend yield of 6.3%, and that compares with a 10-year average of 5.2%. I thought these results were decent. It was a company that when we first started the show was absolutely decimated during 2020, 2021 with the pandemic and the shift towards working from home, online shopping. And you did wonder, will British Land ever properly recover from it? I think it now is recovering well, and it's got its London campuses with high quality office space. People are returning and have been for some time to the office. It's got some prime real estate. It's got science parks, which account for around 20% of its office space, and the Optic in Cambridge being one of the prime examples of that. And I think that's something where there is real growth there. It's also got it diversified and got urban logistics with warehouses and also the retail park business. So I think, on the surface of it, it certainly does look fairly cheap considering all of the above, with real room for growth. I think you would be buying it for that future growth and future earnings through the dividends, rather than buying it today as just a pure income play for the current dividend on offer. Because from the current dividend on offer, as I mentioned before, plenty of other REITs paying higher dividends. But I think if you look at the composition of its portfolio and it investing in that, I think it's actually fairly attractive. And it's, I wouldn't say rock bottom, but it's a pretty lowly valuation for it. So I do actually quite like it. Sam, what are your thoughts?
I am probably not as positive. I think the rental growth's decent, but it's been driven by acquisitions. when you strip that out, it's not as impressive. And I just think the valuation's not terrible, but if it's that low off the book value, based on the performance we've seen of it being like decimated in COVID and stuff, I would kind of question, well, what are the valuations they're using? And is the market valuation of those properties maybe more accurate than the one on the accounts? I think as well, like, there's just so many other REITs at similar prices that I'd want to buy before I get to British Land Co. in sectors that I'd consider to be a lot more attractive longer term. So I think it's just so far down the list, I'd never really look at it because there's so many other REITs that I'd want to own first.
No, fair enough. And in terms of REITs specifically then, do you have any in your own portfolio?
I've got supermarket.
Oh, supermarket.
That's the only one I've got. If I was to have another one, I'd probably take a close look at that. You know, that AEW UK one we looked at a while ago?
Oh, yes.
That looks really interesting. I've always really liked Tritax. It's just never been quite high up enough on the watch list, but it is on the watch list.
Sure.
I think those are probably the two I'd take a serious look at if I wanted to add another one.
Okay, fair enough. Well, on to a debut on the show then.
Yes, so PayPoint. So not a company I was overly familiar with until yesterday. So PayPoint, for anyone who is not familiar with the business, they basically offer quite a lot of services. So what they do is they kind of have a network inside small businesses. So it's kind of like if you were to go into like a corner shop or something, there's certain services that you can get and they're provided by PayPoint within those shops. So you can apply for an international driving permit. You can order foreign currency online and then pick it up free in these stores. Or let's say pick it up free, you're paying via the exchange rate. You can top up your energy meter at a PayPoint store. You can pay your utility bills. You can buy gift cards from their Love to Shop part of the business. They've got Collect Plus, where it's parcel drop off and pick up. That's quite interesting, actually. So Collect Plus in October, international distribution services or whatever they're called. The company that owns Royal Mail, they actually bought 49% of Collect Plus. So they're now rebranding them to kind of part of the Royal Mail network. You can deposit cash and you can also make cash withdrawals. And those are kind of all services that PayPoint will facilitate in the background, but you'll go into like a local corner shop or something like that to go and do it. So they do quite a lot, but maybe not a company you necessarily have heard of. The stores aren't PayPoint branded. It will just be like independent shops. So they have come out with their half-year results and revenue was up 6.7% to 144 million. Net revenue was up 0.1% to 84.7 million. So the difference between the revenue and the net revenue is they kind of strip out commissions that they pay immediately. So there's a lot of that revenue they never actually see. But yeah, so they've stripped that out for net revenue, which is probably the more useful metric. Underlying EBITDA, that was down 0.5% to 37.5 million. The underlying profit before tax was down 4.5% to 25.7 million. And that compares to profit before tax, which was down 13.9% to 19.9 million. So there were 5.8 million of adjusted items. The adjusted items were mainly legal fees that had been incurred in relation to claims against PayPoint, amortization of intangible assets. So, for example, 1.1 million for Love to Shop and 1.5 million for previous acquisitions. Diluted earnings per share was down 12.3%, but the diluted underlying earnings per share was down 2.6%. And the net debt improved slightly from negative 86.8 million to negative 84 million. And that debt has mainly been used for acquisitions. So it was pretty free of debt until a couple of years ago when they started making some of these acquisitions that we've referred to earlier. The CEO, Nick Wiles, has said, as the current year has progressed, we have faced two challenges. Firstly, the impact from the disruption to our parcels network from the harmonisation of InPost and Yodel services combined with the commercial terms of our new 3-year contract has been greater than we had anticipated. And secondly, while ObConnect continues to build its new business pipeline and range of opportunities, the pace of growth and monetising these opportunities in the year is slower than we had planned. In divisional highlights, shopping divisional revenue was up 0.6% to 33.1 million, and service fee net revenue increased by 8.4%. The card payment revenue decreased by 3%. Card processed value decreased by 4.4%. They said they've highlighted positive business performance for business finance via blnd, with over 14.6 million of funding provided to businesses, up 15% year on year. The UK retail network increased to 30,962 sites, with 70% independent retail partners and 30% in multiple retail groups. For the commerce division, net revenue increased by 7.5% to 8.6 million, so that's pretty small, so we won't really focus on that. Payments and banking divisional net revenue, that increased by 4.4% to 26 million. And they've highlighted continued growth through the multi-pay platform, with underlying net revenue increasing by 17.2%. Total digital net revenue increased by 39.7%. The Bank Local service launched in August 2025 for Lloyds Banking Group customers, enabling consumer cash deposits via app across our extensive network of 30,000 locations. Deposits via card for Lloyds in September 2025 launched across 3,000 banks for the service over the course of the next 6 months. Cash payment net revenue decreased by 9.9%, and Love to Shop division revenue decreased by 9.6% to 17 million. They've said it continues to trade in line with expectations for the current year, with reported net revenue affected by the changes to the timing of revenue recognition for expiry of cards following the move to a more prudent accounting treatment in 2024. If you look at the last 5 years, so over that period, firstly, the shares are down by about 27%. And it's been very, well, I say up and down this year. It's been very down this year anyway. So the 52-week high for this year is 870p. It's currently trading at 456p. We'll get onto the valuation shortly, but in terms of the way it's performed in the last 5 years, well, firstly, you get a big jump a couple of years ago, and that's when they acquired Love to Shop, and I think a couple of other bits. So in terms of the revenue, that has grown a lot, but it's really grown through acquisitions. However, it's not really flowing through to operating profit yet. It does sound like they're still building out that network, and there's quite a lot of integration issues. We don't normally talk about analyst expectations because we don't find them overly useful. But analyst expectations were 80% increase in earnings, and that was due to that investment I referred to from Royal Mail into the Collect Plus network. And the idea was that because people were going in for the Royal Mail parcels, they were going to get a lot more footfall in the stores that they're in, and then a lot of other services would probably be used on the back of that. So far, I think there's been integration issues, and that hasn't really happened. But in terms of the valuation, it trades at a P of 6.37 and has a dividend yield of 6.92%. The yield at the minute, I think the cover's quite low. However, if these earnings do start to increase, the cover's going to then go back to a very reasonable level. I actually think this business looks, I'd say, fairly interesting, but it's got fingers in a lot of pies, and actually getting a sort of cohesive sense of how the business fits together and works when I don't really use any of the services, I find quite difficult to kind of visualize the business. I think in terms of that acquisition, I wouldn't necessarily have an issue that a recent acquisition is taking a little bit longer to integrate. However, it's more, for me, it would be the fact that if I were to take a closer look at this, you look over kind of 5 years, and it's not really, I don't think, delivered. If it had that track record of delivery and it had then done the acquisition, at this valuation, I'd probably take a bit more of a deeper look. But I think when I'm struggling to get my head around it, and it doesn't really look like operationally it's been the best performer that I can see, I think I'd probably just give it a pass. Maybe I'd come back and look at it in sort of 6-12 months, but I could take it or leave it. What about you, John?
Yeah, I could very much take it or leave it. I think it's a mixed bag in terms of the results, specifically in terms of the services that it offers. I think Collect Plus, that's definitely something. I think that's more of a growth industry, and you've got a lot of e-commerce. I've used Collect Plus quite a lot myself, or I did for a time at least, when I was selling some things on eBay, and that seemed like a fairly slick operator. It was very easy to use, and I got that kind of corner shop model where you didn't have to go into a bigger town to post your item. It was done fairly low cost, and you'd use your own printer, so they didn't necessarily have to do that for you. So that side of things I thought was fairly attractive. Some other bits I would wonder about within their sort of industry, and whether they're almost older generation type products like paying utility bills and cash withdrawals, and whether those sorts of things are in structural decline, or will be over the next few years. I suppose you might argue that there could be some illicit use of the cash withdrawals and those kind of services, but I think a lot of it could be in structural decline in the near future, and that would worry me if I were, buying for the long term. So it's not really one for me.
Should we move on to Nvidia then?
Yeah, so I suppose this is the case for the future, really. So Nvidia, they had their Q3 results out about 2 or 3 weeks ago now, and they had third quarter revenue up by 62% to $57 billion, beating estimates by 4%. All divisions grew, with data center revenue up 66% to $51.2 billion. Underlying operating profit of $37.8 billion also rose by 62%. Free cash flow increased by 32% to $22.1 billion, and net cash, including leases, stood at $51.1 billion at the end of the period. For the fourth quarter, revenue is expected to be around $65 billion. Share buybacks totaled $12.5 billion, and a quarterly cash dividend of 1 cent a share was announced. And the shares were up around 5.5% in pre-market trading. In terms of valuation, that Nvidia has a market cap of $3.75 trillion, and it trades at 30 times forward earnings, which is actually cheaper than its 10-year average of 37. And yeah, it pays essentially a negligible dividend. I mean, these results, I think the market had been eagerly anticipating these because it's the biggest AI play. And I think if you saw any wobbles in Nvidia's earnings, then you could see the whole market, which a lot of it has that AI hype built into it, could fall significantly. As it happens, they put up the numbers and everything has been pretty stable since then. I mean, they're absolutely phenomenal numbers. I mean, you can't really conceive a company this big with this sort of growth. It is really, really incredible. And it's particularly those data centers that account for 88% of the group's revenue. I mean, it's really interesting if you look back on it, going back, say, 20 years pre-AI, it was all about its sort of essentially gaming division and I guess professional visualization, so doing kind of computer aided design and the graphics cards from that perspective. And now obviously there's this whole new industry of AI, which Nvidia is the sort of almost the definitive AI play. For me, I've got a lot of my money in global indexes, and Nvidia does make up, a large part of that. I don't know whether I would be brave enough to go out and buy Nvidia shares, but I think it's an incredible company, and I'm happy that it makes up a part of my portfolio, so I have, some exposure to it. But a company that's 3.7, getting on for 4 trillion with a valuation of 30 times forward earnings, it's certainly toppy. But I guess when you're, increasing your third quarter revenue by 62%, that's why. Sam, what are your thoughts?
I would largely agree. I mean, the valuation, if it keeps putting up these numbers at a forward P of 30, it's not as ridiculous as it looks when you judge it based on the market cap. I think the issue is we've seen it before. This is probably I think it's a bit of a cyclical business, especially with it being kind of hardware rather than software. And it's getting, I think, a bit of a software valuation. I think the hype around AI has helped, but you saw it in kind of, I guess, with like the crypto and stuff because it was needed for the mining. It had a big run up then as well. Nothing in comparison to what it's had now. But yeah, I'd just be very, very nervous buying a company of this size at this valuation when it's a hardware company. Unbelievable business, but it's like comparing like Apple to Google. Like Google just is inherently more attractive because it's software, and that I'm not taking anything from Apple away as an operator, but it's similar with Nvidia. I just think 30 times earnings for kind of a $4 trillion company that's probably at like the top of its maybe current cycle. And it might be that AI goes on and it's, generating these earnings for 10 or 15 years, in which case you could probably do very well, but I'd just be very, very nervous with it, I think.
Yeah, sorry, I should have corrected myself. I said 3.75 trillion. It's actually 4.26 trillion.
Well, what's 500 billion?
It's just, or I don't know, the top 5, or top 10 FTSE companies put together, maybe.
Exactly. Just a rounding error for the US.
Yeah, that's right. So, Sam, of the companies this week, what would be your top pick and what would come last?
So I think I can't say I actually love any of them this week. I'd probably put Sage top. I think it's probably the best business at the most reasonable valuation this week, but I wouldn't be buying it at 25 times earnings. Last, I think I'd probably put British Land Co. actually. What about you?
Oh, really? Okay. Harsh. I would probably, being boring, I'd probably go for Sage as well, although for the reasons of Zero and the sort of competition, I would be, reluctant to be holding that longer term. I think British Land Co. Yeah, I'm a bit more optimistic about it. Particularly, I think if you look at some of the acquisitions it's made, and not for hugely expensive prices, I think that will come good. But I think it'll be a longer term, play on that. In terms of last, I probably go for PayPoint. Actually, I'm not keen on that. I do feel that is likely to be a business in structural decline, sooner rather than later.
Right, I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.